Welcome back to the deep dive. Our job, as always, is to try and cut through all the noise, to take a really complex financial story and just pull out the insights that, genuinely matter.
Exactly.
And today, we're tackling a company that I think perfectly epitomizes market mood swings. We're talking about PayPal Holdings, ticker PYPL.
Oh, yeah. This one's a roller coaster.
It really is.
Yeah.
I mean, think about it. This is a stock that soared to these just dizzying heights, trading, north of $300 during that pandemic frenzy, only to come crashing all the way back down to where it is today, just hovering around $60 a share. It's an incredible fall from grace.
And that kind of volatility, that extreme emotional cycle, it actually creates the perfect setup for value investors.
Right.
PayPal is, it's an undeniable incumbent. It's an entrenched powerhouse in digital payments. But the market today has priced it for pure pessimism. It's pricing it as if its best days are not just behind it, but as if a long, slow decline is basically inevitable.
And that precisely is why we're here. We are going to apply the most rigorous test that we know, and that is the Warren Buffett framework.
The full treatment.
The full treatment. The mission is crystal clear. We need to figure out if PayPal at this $60 price is just a cheap stock, a classic value trap. Or is it, in fact, a truly wonderful business that the market is currently offering us at a bargain price?
And the core tension driving this whole deep dive, it's really an existential one. Is PayPal a kind of digital utility with a durable, lasting moat that ensures future cash flows? Or is it a fading relic? Is it a legacy system that's just slowly being replaced by the sheer zero-friction convenience of OS wallets like Apple Pay and the power of developer platforms like Stripe?
That's the billion-dollar question. So to answer it, we're going to filter PayPal through the 4 qualitative gates of the Buffett framework. We'll look at the business, the moat, the management, and the industry.
And then, crucially, we'll get to the numbers.
Exactly. Then we move to the quantitative segment, and we will rigorously calculate its intrinsic value based on what Buffett calls owner earnings. This deep dive is designed to give you, our listener, the shortcut to understanding whether that $60 price point is justified or if it might just represent one of the biggest market mispricings of the decade.
Let's get into it.
All right, let's start right where Buffett always starts, the circle of competence. First question. Do we actually understand this business?
I think we do.
Because despite all the, the complexity of global finance and all the fintech jargon they throw around, the core model of PayPal seems elegantly simple.
It passes gate 1 with flying colors, I think, because all that complexity is, for the most part, hidden from the user. At its very essence, PayPal is a digital toll bridge for commerce.
A toll bridge? I like that.
That's what it is. They facilitate secure transactions between consumers and merchants. It doesn't matter if you're shopping online, sending money to a friend with Venmo, or, wiring funds internationally through Zoom. Their revenue model is just as straightforward. They charge a small percentage fee, a toll, on the transaction volume that they process.
Yeah, I think we can apply what we call the elementary school test here. If I had to explain this to a kid, I'd say something like, PayPal is the invisible friend that helps you shop online safely.
Perfect.
You tell it where you want to go. It moves your money super quickly and securely, and it just charges a tiny, tiny fee to do all that heavy lifting while keeping your personal details a secret.
That is the perfect description. And the simplicity of that core function, that electronic money transfer and secure storage of value, that's the key to the second part of gate 1, which is predictability.
Right. Will this business even be around in 10 or 20 years?
Absolutely. The secular trend of cash moving to digital is, it's global and it's accelerating. And PayPal has already proven its resilience, right? It successfully transitioned from the early desktop web of the late 90s and early 2000s.
The eBay days.
Exactly, the eBay days to the current mobile-first environment. That's a huge transition they've already navigated.
And it seems like they're actively trying to position themselves to ride the next waves of technology, not get swept away by them. We saw them launch their stablecoin, PYUSD, back in 2023, which suggests they're at least exploring the utility of crypto rails for efficiency.
They're dipping their toes in. But I think the more immediate and impactful thing is their leverage of AI.
Yes.
AI is a huge tailwind for them, primarily in fraud detection. In a business where trust is literally everything, using advanced machine learning to spot and block fraudulent transactions, that maintains the security and integrity of the entire platform.
So it's not a threat, it's a tool.
It's a massive tool. If you have fewer fraud losses, you protect your margins and you maintain that critical consumer and merchant trust. So, PayPal isn't just reacting to technology, they're using it to enhance their core competency. And that adaptability, that gives us really high confidence in that 10-year predictability test.
Okay, so the business is simple and it's predictable. It passes Gate 1. Now for the really crucial step, Gate 2, the moat test. What durable competitive advantages does this company have that protect its profits from all the fierce competition out there?
Well, the moat really has three primary components. The first one is intangible assets, which for PayPal is dominated by one thing: brand trust.
The original.
They pioneered online payments starting way back in 1998. They are the original safe haven. In the financial world where, data breaches are common and fear of identity theft is super high, that long legacy of security is incredibly valuable.
And that trust, it's not just a fuzzy feeling. It translates directly into merchant behavior.
Right. Precisely. Merchants will willingly accept a slightly higher processing fee from PayPal than from some generic unknown processor because they know that consumers actively seek out and trust that blue Pay with PayPal button.
Right.
That brand premium acts as a barrier to entry for smaller players, and it gives PayPal this subtle but very real pricing power, which I promise we will drill down into later.
But the real behemoth of the moat, the thing everyone talks about, it has to be the network effect. It's just a classic two-sided market.
It is, without a doubt, the most powerful element. PayPal boasts just immense scale. We're talking 434 million active consumer accounts and 36 million merchants as of the end of 2024.
Those numbers are staggering.
They are. And think about the logic loop here. Consumers use PayPal because they know that 75% of the top 1,500 online retailers accept it. And merchants, conversely, must accept it because they know that hundreds of millions of customers already have their payment credentials stored right there, ready for a one-click checkout.
It's a flywheel.
It is. This ubiquity, being accepted on over 10 million websites, gives PayPal roughly a 45% market share of online checkout. It just dwarfs any individual rival.
That ubiquity sounds like incredibly deep entrenchment. But okay, let's pause here and introduce some, intellectual friction.
Let's do it.
A lot of smart people, including analysts at Morningstar, rate PayPal as a narrow moat business. They argue that on mobile, especially here in the U.S., Apple Pay is actively undermining that network effect by controlling the gateway, the NFC chip, and the mobile OS checkout flow.
That's the bear case.
Right. So how durable is the network if the operating system itself is actively trying to throttle it?
And that is the right challenge. It's the central question. If the moat were based purely on, say, technical superiority, it would indeed be narrow and very vulnerable. But the moat is economic and it's behavioral.
Okay, unpack that.
Apple Pay is formidable, no doubt, but it's formidable for in-person tap to pay and for in-app mobile checkout, where it removes friction completely. However, PayPal's moat persists in some very specific high-value areas.
Such as?
1. Merchant conversion. We mentioned this earlier, but it's critical. Merchants see a documented 25% higher checkout conversion rate on average when they offer PayPal.
That's a huge number.
It's a measurable economic benefit that Apple Pay right now just doesn't promise. Merchants are paying for sales, they're not just paying for payment processing. 2. Global reach. PayPal operates in 200 markets with local regulatory licenses. Apple Pay's reach is still geographically and functionally much more constrained. And 3, cross-border transactions. PayPal just handles complex international payments better than most OS wallets.
So the switching cost isn't really technical, it's financial. Merchants don't want to switch because they would literally be sacrificing measurable revenue.
Exactly. And on the consumer side, the switching cost is behavioral. It's just inertia. Over 80% of U.S. adults have used it. It's the path of least resistance. It's safe, it's saved, and it's trusted. You have to actively choose to delete your PayPal account and move all your credentials somewhere else, which, let's be honest, very few people are going to bother to do for a marginal gain.
And what about the float? That's a huge pool of customer funds. How does that factor into the economic mode?
The float is a massive and I think deeply unappreciated competitive advantage. As of recent filings, PayPal holds around $37.7 billion in customer funds.
Wow.
This is money that you, the listener, have stored in your PayPal or Venmo account, just waiting to be spent. PayPal can invest this float in safe, short-term securities and generate interest income. And that interest income effectively offsets a portion of their operating costs.
Which lets them keep their margins high.
Precisely. It allows them to maintain those high gross margins, around 50% per dollar processed, even while they're under pricing pressure from rivals. This scale efficiency protects their bottom line in ways that smaller competitors just cannot replicate.
So to sum up Gate 2, while the competition is definitely fierce, the combined weight of the brand, the two-sided network, the measurable conversion uplift for merchants, the global licenses, and that benefit of the float.
Yeah.
It leads you to judge the moat as wide and stable, despite the strong argument for narrow.
That's where we land. It's wide because the economic pressure to switch is just so high for merchants, and the barrier to replicate that global network is nearly insurmountable for any new entrant. The moat is enduring, and that makes this a high-quality business.
Okay, but a high-quality business only stays high quality if it's run by capable management. So let's move on to Gate 3, management quality. This is critical because the story of PayPal over the last 5 years is really a tale of two distinct management eras.
Indeed it is. We are evaluating the current leadership under CEO Alex Chriss, who took over in late 2023. And we have to acknowledge the legacy he inherited. While the previous regime delivered immense growth in payment volume, there was a noticeable lack of deep personal skin in the game by Buffett standards.
Right.
And crucially, there was a focus on growth at any cost that led to some significant misallocation of capital.
Let's drill into that capital allocation history, specifically the acquisitions, because this is where intellectual friction is really required. The previous leadership spent billions on deals that look, in hindsight, highly questionable.
You absolutely have to separate the good from the bad here. The acquisition of Braintree and Venmo back in 2013 was a masterstroke. It was brilliant.
Yeah.
It provided the critical API infrastructure and that social P2P layer that has generated just massive, massive volume. That shows incredible foresight.
But the later deals, the ones driven by, the speculative frenzy during the peak of the market bubble, those are more concerning.
Absolutely. The missteps involved billions and billions of dollars.
Yeah.
They paid $4 billion for Honey in 2019.
$4 billion for a coupon extension.
It's essentially a coupon browser extension. And while it integrated some loyalty and shopping services, that price tag was just exorbitant for the marginal value it delivered. Then, in 2021, they paid $2.7 billion for Paydi, a Japanese buy now, pay later firm, right as the BNPL hype reached its absolute zenith.
So they bought at the top.
You bought at the very top. That was almost certainly an overpay designed to chase a very fleeting trend.
Okay, so if we just total those two missteps alone, that's $6.7 billion in potentially poorly allocated capital. And this created $10.8 billion in goodwill on the balance sheet, which is about 55% of the total equity.
A huge number.
Right. That level of goodwill coming from overpaying for assets, it presents a material risk for impairment down the road. So how can we rate management highly when they engage in that kind of speculative overspending?
That's a very fair challenge, and it's why the management score has to be conditional. We rate the current management highly, not for those past decisions, but for the shareholder-friendly pivot they executed starting in 2022.
The course correction.
The course correction. The biggest sign of maturity was abandoning that highly unrealistic target of reaching 750 million user accounts. That was a growth target completely divorced from profitability. By pivoting to focusing on high engagement, high-value users and shedding unprofitable customers and merchants, they signaled a disciplined, profit-oriented focus.
The ultimate redemption, though, at least in the eyes of a value investor, has to be the aggressive share buyback program. This is the hallmark of management with an owner's mindset, recognizing that their own stock is undervalued.
This is the positive turn in the story. They recognized the market was mispricing their company, and they deployed capital aggressively and, I would say, disciplinedly. Just consider the numbers.
Lay them out for us.
In 2022, they bought back $4.2 billion worth of shares when the price averaged around 103 TARs. A little high, but justifiable at the time. In 2023, they bought back $5.0 billion at a much, much better average price of $67.70 per share.
Much better.
And in 2024, they continued that aggression with another $6.0 billion purchased at an average price near $65.60.
And those purchases, especially the ones below $70, are Buffett's favorite way to return capital to shareholders. They were buying their own business for less than its conservative intrinsic value, immediately generating value for all the remaining shareholders.
Exactly. This entire campaign reduced the total share count by approximately 18% between 2021 and 2024. That is a massive, tangible value add. If the company achieves flat net income over the next 2 years, EPS will still grow significantly just because there are fewer shares outstanding. This strategic use of buybacks is the primary defense for giving the current management a high-quality rating, despite that acquisition history.
And this whole disciplined approach, it's been formalized in what you call the CRIS doctrine, the pivot to profit and efficiency.
The CRIS doctrine is pretty simple. Shift PayPal's identity from a speculative growth play to a disciplined cash flow generating operator. And they achieved this through aggressive cost efficiency measures. They had multiple workforce reductions, which led to a 21% contraction in headcount over 4 years. They now have a much leaner organization of about 24,400 employees.
And that structural optimization, it immediately boosts margins.
And
the financial reflection of this whole new doctrine is the move away from chasing total payment volume, or TPV, to prioritizing something called transaction margin dollar, or TMCen. What does that shift really tell us?
It's the most important metric shift in the company's recent history. TME measures the net profit after the key variable costs, so transaction costs and credit losses. It directly reflects the true profitability per transaction.
The quality of the dollar, not just the quantity.
The quality of the dollar, exactly. By prioritizing TME, management confirmed they are willing to shed high-volume, low-margin, or even unprofitable business. So in Q3 2025, while TPV growth was a pretty moderate 8%, the crucial TME grew 6% year-over-year to $3.87 billion. The takeaway is this. TPV volume might slow down, but the quality and the profitability of that volume is soaring. They are focused on monetizing the 434 million users they already have, not just adding more debt accounts.
And the crowning achievement of this pivot to stability and confidence, I suppose, is the initiation of the dividend.
That's the signal of maturation. Starting PayPal's first ever dividend program in 2025, it tells the market, we are confident in our durable, recurring, free cash flow.
We're a grown-up company now.
We're a grown-up company. The company projects robust FCF of $6 to $7 billion for 2025, and starting the dividend with a really low 10% payout ratio, it confirms that management sees the business as a compounder, and they're trying to attract a whole new class of income-oriented investors.
Okay, finally, gate 4. Industry structure and rationality. We've established that competition is fierce, but is it ruinous? Is everyone just cutting prices to the bone?
No, not really. Payments is generally a favorable industry for the scaled incumbents. It is capital light, which means low CapEx requirements, and that leads to high returns on capital. It's an oligopoly, really. You have PayPal, Stripe, Adyen, Apple Pay, where pricing is competitive, but it's generally rational.
And the barriers to entry are high.
Very high. The high barriers, driven by the need for global regulatory licenses and incredibly complex anti-fraud systems, they protect the existing players. So while it's not some cozy monopoly, it certainly fits the Buffett ideal of a high-return, non-capital-intensive sector.
Okay, so the qualitative boxes are checked. Now let's really drill into the engine's performance, the unit economics. We need to quantify the value proposition for both consumers and merchants.
Let's start on the consumer side. In an environment that is just saturated with payment options, the core offer from PayPal remains the same: simplicity, security, and buyer protection. PayPal lets you transact globally without exposing your actual card details to hundreds of different merchants, which is a critical feature.
And we have data to back up that security claim.
We do. Over 60% of consumers surveyed stated they trust PayPal with their data more than their own primary bank for online transactions.
That's a powerful statement.
It's a massive intangible asset. Then you layer on Venmo, which provides a simple, social, peer-to-peer instant cash replacement. That dramatically increases the stickiness and the frequency of use, especially among younger demographics.
And then on the merchant side, the value is much more mercenary. It's about sales. Cold, hard cash.
Exactly. They pay the toll because they make more money. It's that simple. We've referenced that documented 25% average boost in checkout conversion rates. For a large enterprise, that 25% lift in sales, it far outweighs the marginally higher transaction fee that PayPal charges compared to, say, a generic card processor.
So PayPal is paying for itself by reducing that card abandonment friction.
Exactly. It solves 3 core merchant frictions: sales conversion, global acceptance, and fraud loss management.
Let's talk some rough math. The overall take rate is about 1.9% of the total volume, and the transaction expense is about 0.93%. That leaves us with that pretty impressive gross margin.
Yes. That 50% gross margin on each processed dollar is the evidence of the economic value add. If PayPal were just a commodity processor, that margin would be razor thin. The high margin confirms that they are charging for a service that simplifies life and generates value for both sides of the network.
And the economics of customer acquisition must be stellar, I imagine, given the age and ubiquity of the platform.
Oh, they are. Their customer acquisition cost, or CAC, is incredibly low. It's largely because of viral marketing and organic network effects.
Wow.
Venmo is a key driver here, as young users just organically onboard their friends to pay them back for things.
Right.
And you compare that low CAC to the customer lifetime value, the CLV, which is incredibly high. The average active user performs approximately 60 transactions per year. This stellar CLV to CAC ratio tells you that once they acquire a user, that user monetizes reliably and repeatedly, sometimes for decades, which makes the whole business highly efficient.
Now let's talk about the resilience of this revenue. Transaction-based revenue, it sounds volatile on the surface, but you argue it's actually highly predictable.
It's high quality because of its recurring nature. Over 90% of their revenue comes from existing customers. That volume isn't dependent on them continually acquiring new users. It's dependent on the habitual behavior of their massive installed base.
So it's almost like a subscription.
It acts like a subscription model, just without the contractual lock-in. And furthermore, the revenue is geographically diversified, with about 43% coming from international markets. That really dampens the effect of any single regional economic slowdown.
Okay, the acid test of any economic moat is pricing power. Did PayPal really prove they could raise prices without suffering a mass exodus of merchants?
They did, emphatically, back in 2021. This anecdote is absolutely crucial to the thesis.
What happened?
PayPal raised merchant fees for its branded checkout in the U.S. by about 20%. They moved from 2.9% to 3.49% plus a 49-cent fixed fee. This was a significant hike.
And what happened? Did merchants flee?
The expected merchant exodus, it just never materialized. While some of the really large enterprises may have grumbled and negotiated, the vast majority of small to medium merchants who rely so heavily on that conversion boost, they just accepted the fee hike. This is empirical, real-world proof of pricing power in their core branded product.
And we also noted the built-in inflation hedge.
It's a simple but very powerful benefit. Since PayPal's fee is percentage-based, if inflation causes the price of a pair of shoes to go up from $100 to $110, PayPal's cut automatically rises, even if their own operational costs remain stable.
So their revenue just floats up with inflation.
It ensures their margins are protected during inflationary environments. So overall, we can conclude that the pricing power is moderate to strong, and it's certainly sufficient to protect their margins against competitive pressure.
Okay, let's leave the qualitative story for a moment and move to the hard science of finance. Buffett is obsessed with cash flow because, as he says, cash is a fact. We need to verify the quality of these high returns using the financial statements. Let's start with the cash conversion rate.
The cash conversion at PayPal is, frankly, exceptional and a massive green flag. In 2024, the company reported a net income, or NI, of $4.15 billion. However, their operating cash flow, or OCF, for that same period was a whopping $7.45 billion.
So that's nearly a 180% conversion rate of accounting profit to actual cash.
Exactly.
Just to be clear for the listener, if net income is the reported accounting profit, why is PayPal stuffing an extra, $3.3 billion into its cash account?
Well, the difference is primarily driven by non-cash charges that are deducted before you calculate net income but don't represent a real cash expense leaving the business. The biggest ones are depreciation and amortization and, crucially, stock-based compensation, or SBC.
Right. Paying employees with stock.
Correct. PayPal pays its employees partly in stock, which is an expense on the income statement, but it doesn't actually deplete the company's cash. So we add these non-cash charges back to find the true cash generated by the operations. This high conversion rate, it confirms the financials are conservative and clean. They are not generating phantom profits through aggressive accounting.
And this leads us directly to the holy grail for value investors.
Yeah.
Owner earnings. This is the true cash flow available to shareholders after all necessary expenses, including maintenance, are paid.
Yeah.
Let's walk through the derivation of that $5 to $5.4 billion figure.
All right. We start with our normalized net income, which in 2024 was around $4.15 billion. We then have to make two key adjustments to get to owner earnings.
What are they?
First, we add back that stock-based compensation. As we noted, it's a non-cash expense. PayPal's SBC in 2024 was about $1.23 billion. We add this back because it's cash that is not leaving the building.
Okay, that makes sense.
Second, we subtract maintenance capital expenditures, or CapEx. This is the cash required simply to keep the business running, things like replacing old servers or renewing essential software licenses. And PayPal is a very capital-light business. They don't operate factories or physical infrastructure. So we estimate their maintenance CapEx CapEx very conservatively at about $1 billion annually.
So if we take the $4.15 billion in net income, we add back the $1.23 billion in stock comp, and then we subtract the $1 billion in maintenance CapEx, we arrive at a normalized owner earnings figure of approximately $4.38 billion.
That's the low end. If you take the higher operating cash flow number and just subtract that estimated $1 billion in maintenance CapEx, you get closer to $6.45 billion.
So that's a pretty wide range.
It is, and that's why we use a normalized midpoint. We estimate owner earnings are comfortably between $5 and $5.4 billion. The key takeaway here is that their maintenance CapEx is low, which means their free cash flow is high, $6.8 billion in 2024. This is the textbook definition of a capital-light growth model. They don't need heavy reinvestment to expand their digital toll bridge.
Now for the quality check. Returns on capital. The undisputed benchmark for this is return on equity, or ROE.
And PayPal is a stellar performer here. They have consistently delivered an ROE in the 15 to 20% range over the past decade, and 2024 saw it hit 20.3%.
Which is significantly above Buffett's 15% hurdle.
It is. It confirms the quality of the business engine. A company that can consistently generate 20 cents on every dollar of shareholder capital is, by definition, a compounding machine.
But is this high ROE achieved through dangerous leverage or debt?
No, and that's what makes the 20% figure so strong. Their high ROE is driven primarily by operational efficiency, and that benefit from the float, not from debt. And to demonstrate the quality of the core payments business, we can look at an even more stringent metric, return on tangible equity, or ROTCE.
Okay, so what does ROTCE tell us that ROE doesn't?
It filters out the noise. Tangible equity excludes all the intangible assets, like the goodwill from those acquisitions we questioned earlier, Honey and Patey.
The expensive ones.
The expensive ones. When we exclude that $10.8 billion in goodwill from the calculation, the ROTCE skyrockets to approximately 45%.
Wow.
That figure tells you that the core PayPal and Venmo payments engine is exceptionally high return and hyper-efficient. The only reason the overall ROE is only 20% is because those less efficient acquisitions, that goodwill, are dragging the average down. It proves the underlying payments utility is pristine.
That distinction is so critical for the listener. The core business is a 45% return machine, but some poor capital allocation knocked the overall metric down to 20%. All right, let's conclude this segment with the Fortress balance sheet test.
PayPal passes this with flying colors. Financial safety is paramount. Their liquidity is just immense. They hold between $14.4 billion and $15.4 billion in cash, equivalents, and short-term investments. Their total debt is manageable, fluctuating around $10 to $11 billion.
So we have a clear net cash positive position.
Correct. They hold approximately $3 to $5.5 billion more cash than they owe in debt. This is extremely rare among technology and fintech companies, which often use a lot of leverage to juice their growth. This net cash position is a massive safety cushion, and it provides enormous optionality for strategic investments or, future buybacks.
And the debt safety ratios, like interest coverage.
Stellar. Their interest coverage ratio, which is how easily they can cover their interest expense with their operating profit, is extremely high, around 14.5 times. Buffett likes to see anything over 10x. So in short, they could pay off their entire debt load very quickly, and their interest payments are an insignificant cost relative to their cash generation. This is a fortress balance sheet, and it offers immense downside protection.
Okay, so we've established that PayPal is a high-quality cash-generating business with a wide moat, even if it's being challenged. The market's pessimism, then, must stem almost entirely from the competitive landscape. So we need to analyze this competitive struggle in real detail.
We are in what I would call a tripartite war for the checkout button in 2025. You have the network incumbent, which is PayPal. You have the developer platform, which is Stripe. And you have the OS integrated wallet, Apple Pay.
Let's start with a threat to their Braintree unit. Let's talk about Stripe.
Stripe is, without a doubt, the most formidable competitor in the enterprise sector. They focus on developer experience, API modularity, and lightning-fast onboarding. They are the favorite choice for high-growth, modern tech companies.
Right.
And PayPal's Braintree has been forced into intense pricing warfare with Stripe in this segment, which has eroded Braintree's margins. However, Stripe lacks the one critical element that PayPal has: those 434 million active consumer accounts that choose PayPal. Stripe is invisible infrastructure. PayPal is a brand and a conversion tool.
But the more existential threat, the one that makes the market so nervous, has got to be Apple Pay. They control the mobile experience.
Apple Pay is the ultimate threat because it controls the point of friction on the device itself. Apple Pay commands a 92% market share of mobile wallet transactions in the U.S. and is processing an estimated $7.6 trillion globally in 2025. Trillion. Far surpassing PayPal's total payment volume. The zero-click convenience enabled by Face ID and Touch ID, it completely eliminates the very friction that PayPal was built to solve. Every time a consumer defaults to Apple Pay on their mobile device, PayPal loses a little bit of relevance.
So how is PayPal, as the established network incumbent, responding to this huge systemic mobile threat?
They've developed some pretty sophisticated countermeasures. The primary defense against that zero-click experience is a new product called Fastlane.
Okay, tell us about Fastlane. How does it work and is it effective?
Fastlane is PayPal's attempt to unbundle the credential from the traditional login process. So instead of needing to click the PayPal button, log in, confirm, and then check out, Fastlane uses device recognition and encrypted tokens to automatically pre-fill your payment and shipping details across their massive network of participating merchants, even if you're checking out as a guest.
So it's trying to mimic the Apple Pay experience.
It's designed to match that zero-click, low-friction environment that Apple Pay pioneered. It's a direct countermeasure to cart abandonment caused by login fatigue, and it's a crucial defense of their conversion mode.
Okay, so that defends the button on existing websites. But their other major offensive move, PayPal World, that focuses on global expansion in regions where they don't dominate.
Right. PayPal World is a very strategic move to position PayPal as the universal translator of global commerce. PayPal recognizes that in markets like India with UPI or Latin America with Mercado Pago, local wallets are king.
They can't just barge in.
Exactly. So instead of trying to dominate those markets with the PayPal brand, they are integrating these disparate local payment methods into a single unified experience. This initiative allows a merchant using PayPal in, say, the U.S. to easily accept payments from a customer using UPI in India. It aggregates all these local rails, it captures critical cross-border volume, and it connects PayPal's 430 million users with billions on these partner platforms, vastly increasing their transactional surface area.
And this leads us to the crucial forward-looking question. How does PayPal ensure relevance in the age of generative AI, the whole concept of agentic commerce?
This is where the long-term strategic value really lies. Agentic commerce means AI agents, like the ones developed by OpenAI, Google, and Perplexity, all of whom PayPal has partnerships with, will eventually autonomously execute purchases for the user.
So the AI does the shopping.
Exactly. Think of an AI finding you the best flight, booking the best hotel, or buying the best laundry detergent based on your preferences. If the AI executes the purchase, it bypasses the traditional web checkout button entirely.
So the goal of these partnerships is to embed PayPal as the default payment rail within the AI's operating system.
That's the game. It's a proactive defense against being disintermediated. If PayPal is integrated at the foundational level with these AI platforms, then when the AI agent makes an autonomous purchase, it just defaults to PayPal's secure credential vault and processing rail. This ensures PayPal remains relevant even if the traditional user interface disappears.
Let's also briefly touch on the stablecoin PYUSD, which seems to be much more about utility than speculation.
Yeah, PYUSD, with its market cap of $3.8 billion, is being used as payment infrastructure, not just a trading asset. They've integrated it into Zoom for remittances, allowing settlement partners to use this digital dollar for cross-border transactions. This reduces friction and cuts down on the capital required for pre-funding accounts in foreign currencies.
Interesting.
And they're leveraging this further with a USD.AI initiative, which offers a yield on PYUSD deposits to fund AI infrastructure. It's creating this sort of low-cost, symbiotic digital ecosystem that enhances their technological lead.
Before we conclude the competition segment, we have to address the risks, specifically the regulatory wins and the operational vulnerabilities.
The regulatory landscape has been surprisingly favorable for them recently. PayPal secured some critical legal victories in late 2025. They successfully defended against an antitrust class action lawsuit that was challenging their anti-steering rules. With the court ruling, they lacked monopoly power.
A big win.
A huge win. And they also prevailed against the CFPB in a case regarding onerous disclosure requirements on digital wallets. These wins defend their current pricing architecture and reduce future compliance burdens.
And the EU's Digital Markets Act actually provided a massive strategic unlock for them.
That's a huge opportunity. The DMA forced Apple to open its NFC chip on iOS devices in Europe. This allows PayPal to deploy tap-to-pay functionality, enabling them to compete directly with Apple Pay for physical retail transactions in the highly lucrative European market, an area that was previously completely blocked by Apple's control over the hardware.
Now, for the vulnerabilities, I've heard horror stories from small business owners about the fear of the freeze. This merchant trust deficit seems like PayPal's greatest long-term vulnerability. Is that quantifiable in our risk analysis?
It's their Achilles heel. While we can't quantify the exact cost, the merchant trust deficit is the biggest risk that can erode the moat over time. The fear of the freeze, where funds are just locked for 180 days due to these opaque AI-based risk triggers, is widely discussed among merchants. If a competitor like Stripe can match the conversion uplift but offer significantly better human-supported customer service, a merchant exodus, especially among small and medium businesses, could really accelerate.
And there are operational risks, too.
Absolutely. We saw that August 2025 system update error in Germany, which temporarily blocked 10 billion euros in direct debits. That damages trust in a crucial high-value market.
And the need to transition to biometrics to fight cyber threats.
Precisely. The credential stuffing attack in 2025, where 15.8 million credentials were sold online, it just underscores that PayPal has to transition its users rapidly to biometric and device-based authentication to maintain security and trust. This operational risk demands constant vigilance.
Okay, we've established that PayPal is a high-quality, cash-generating business, battling fierce competition, but executing a decisive turnaround under Christmas. Now, let's quantify the opportunity. What is this business actually worth? We have to apply the discounted cash flow method using our conservative Buffett-style assumptions.
Okay, so our foundation is that normalized owner earnings figure we derived earlier. We're going to settle on a conservative midpoint of $5 billion annually, which translates to about $5.05 per share. And we will maintain our standard 10% discount rate, which represents our required hurdle rate for this investment.
Time for the scenarios. Let's start with the ultra-conservative case. The one that assumes total stagnation.
Scenario A, the ultra-conservative zero growth case. We assume the turnaround fails completely, competition forces margin compression, and owner earnings stay flat at $5 billion forever. The calculation is simple. $5 billion divided by our 10% discount rate. The result. This yields an intrinsic value of $50.50 per share. If you believe PayPal will stagnate forever, then yes, the current $60 price is indeed too high.
Okay, scenario B. This one accounts for minimal GDP-like growth. This is our conservative baseline, assuming management simply survives and manages the existing network.
Scenario B, GDP-like growth, 3% perpetuity. Here we assume PayPal manages a very modest 3% long-term growth rate forever. This is highly conservative for a company that's riding the secular digital payments wave. Using a growing perpetuity formula, this yields an intrinsic value of approximately $74 per share. This is our baseline, highly conservative valuation.
And now the plausible mid-case scenario. This one assumes the Chris turnaround actually works, that the cost cuts stick, and the buybacks continue to compound EPS growth.
Scenario C, moderate execution, 6% growth for 10 years. This scenario assumes the management team successfully delivers sustained margin expansion and uses those buybacks to generate approximately 6% annual owner earnings growth for the next decade before settling into that 3% perpetuity growth rate thereafter. This is realistic given the 18% reduction in share count they've already achieved. The result here, the intrinsic value shoots up to approximately $95 per share.
So we have an intrinsic value range from $74 on the conservative end to $95 on the more optimistic but still plausible end. And this is all against a current market price of around $60 per share. This confirms the market is deeply pessimistic. Let's do the reverse DCF to understand just how pessimistic.
A reverse DCF reveals the market's implicit forecast. If PayPal is trading at $60 a share, which is a market cap of roughly $60 billion, the market is pricing PayPal for a long-term growth rate of only about 0 to 2%.
0 to 2%.
It implies the market believes the combined power of Apple Pay and Stripe will completely negate any underlying growth in e-commerce or any internal efficiencies they create.
And that deep dissonance between a 20% ROE, net cash positive business, and a 0 to 2% growth forecast.
Yeah.
That is the heart of the opportunity. So what is the resulting margin of safety?
Well, relative to our conservative baseline, scenario B at $74, the stock offers a healthy 19% margin of safety. However, relative to the more plausible scenario C at $95, the discount is a massive 37%. For a high-quality business with a fortress balance sheet, this is a significant discount that meets our threshold for investment. If we just take a midpoint intrinsic value of around $85, buying at $60 offers a nearly 30% margin of safety.
So you're saying we are buying a financially strong, high cash flow, 20% ROE business at only about 12 times normalized owner earnings. The downside risk is protected by that massive net cash position and the diversified recurring revenue stream.
The investment thesis is structurally sound. The upside, if the Chris turnaround successfully delivers sustained mid-teens EPS growth fueled by margin expansion and aggressive buybacks, is substantial. We could easily see a reversion to the mean valuation, taking the stock back into that $80 to $90 range within a couple of years.
All right, let's review the final scorecard.
The qualitative criteria, the moat, the ROE, and business understanding, they are all highly rated, scoring above 4 out of 5. Management is rated highly based on their recent capital allocation discipline and strategic pivot, not their historical acquisition failures. The only friction points are the reinvestment runway and the industry structure, which score an adequate 3, reflecting the capital-light nature and the intense competition. But the overall weighted score comes out strong at 4.15 out of 5.
Which, based on our decision matrix, places PayPal squarely in the buy aggressively range, meeting all the criteria for a classic deep value opportunity.
It passes the desert island test because the business is understandable and enduring. It passes the family net worth test because of the immense financial safety provided by that fortress balance sheet. The market, in its pessimism, has given us a chance to buy a high-quality compounder for the price of a struggling commodity business.
That concludes our deep dive into PayPal holdings. What stands out most profoundly to me is just the sheer dissonance between the underlying business reality, that 20% ROE, the $5.5 billion net cash buffer, and the market's expectation that PayPal will effectively stop growing forever, reflected in that 0 to 2% implied growth rate.
And the central finding is that this low expectation is the source of the opportunity. Management's successful pivot, focusing on the higher margin transaction margin dollar and the execution of those massive share buybacks, is setting the stage for EPS growth that should easily exceed the market's pessimistic forecast.
All right, so here is the crucial forward-looking thought we want to leave you with, looking ahead to 2026 and beyond. The battle for payments is shifting, and it's shifting fundamentally. It's no longer about who has the best app, it's about who wins the battle for agentic commerce.
We've seen the evidence of PayPal's strategic partnerships with AI leaders like OpenAI and Google. The provocative question is this: if AI agents start autonomously shopping for us, bypassing the traditional merchant checkout page entirely, which payment rail will they be programmed to default to? Is PayPal's strategic positioning in the AI sphere enough to defend the company against the inevitable obsolescence of the traditional checkout button? Or will the device OS, Apple, still maintain the upper hand even in the AI future?
Your homework, then, is to reflect on your own usage. Think about the friction or the lack thereof in your own transactions. When you shop online, how often do you truly choose PayPal versus just defaulting to a saved card or Apple Pay? Does your purchasing behavior align with the market's pessimistic view that PayPal is losing relevance? Or is its inherent globally licensed trust and ubiquity simply too powerful to ignore?
We encourage you to use this rigorous framework, apply these qualitative gates, and, of course, conduct your own due diligence before making any investment decisions. This analysis is based on publicly available sources and is purely for educational purposes. We also encourage you to look deeper into the broader market temperature. Welcome to search for and download the iOS app Buffett Indicator from the Apple App Store, which can help you track total market temperature daily.
Thanks for dining deep with us. We'll catch you on the next one.